Hi everyone, happy Halloween. Hope all of you are doing well. I've got 4 spooky reasons why you should really be paying attention to the financial markets and the stock market and why we're likely due for another correction. My name is Michael Hernick. If you don't know who I am, I have a Facebook page called The Financial Mechanic and a YouTube channel called The Financial Mechanic where I talk about business, economics, money, finance, and so on. So please, if you find this video helpful, please share this. Please click like on my Facebook page, and more importantly, subscribe on YouTube. Okay, let's get into it. So I created a video late last year talking about how we're due for a correction this year. Again, I didn't foresee the coronavirus pandemic to occur, but that certainly caused the markets to act negatively in March and April, as we saw. So what has happened is now the stock market is kind of back up to previous levels. There's been some downward pressure over the last week or so. But I wanted to sort of shoot this video to give you 4 sort of reasons why I think we're due for another correction. Likely in the short term, it may not happen this year, likely next year. First reason is regarding the stimulus. What has happened is the federal government has put in a lot of stimulus into the system for individuals, for corporations, for businesses, and so on, which has effectively caused asset prices to rise. And what it has also done is it has allowed businesses that would have otherwise failed or likely have done poorly to continue to sort of sustain operations. I'm not saying the stimulus wasn't needed. In fact, I think it was needed. But what has happened is particularly to businesses is that there's been money given to businesses that have allowed them to continue operations. And if that stimulus was not there, those businesses likely would not have done well. And may have actually gone out of business. So why is that important? Why may that cause some downward pressure in the markets? Well, at some point the stimulus will end and will not continue for businesses. And when that happens, you should expect that there will be some negative consequences in the business market. And you already see this. There's been many big brands that have filed for bankruptcy and aren't doing well. You can see companies like David's Tea, Moore's, and others that aren't doing well financially, and in my opinion, this is just the beginning. Although the stock market is doing really well. So again, I've talked about this disconnect between the Main Street and the Wall Street. So watch my previous videos if you want to see that. Another reason why I think there's going to be some downward pressure is regarding the elections next week. So regardless of what happens in the U.S., expect volatility. Every time there are, geopolitical factors like a large election, this will cause volatility in the marketplace. So that doesn't necessarily mean that a crash will happen. It just means that there will be volatility, likely some sort of downward pressure as well there. But that will likely cause some movement in the marketplace. The third reason why the stock market likely is due for another correction is that the markets are in a hyper bubble or overvaluation. How do you know this, and and what are sort of the factors and red flags? First of all, many of the businesses on the stock market are way overvalued. To give you some examples, so one way we can look at the valuation of a business is through what we call the price earnings ratio, which basically tells us how much are investors willing to pay for a stock of the business. So Tesla, for instance, has a significantly high PE ratio, which is last year was in the 400s. And you have companies like Amazon that have a PE ratio of in the hundreds, and others that have many similar examples like this. And just to give you a perspective, typically the average price to earnings ratio, again, depending on the year and so forth, is usually in the 30s. Buffett has a Buffett indicator as well. Warren Buffett has something that sort of illustrates the concept really well. So if you're interested in this topic, you can go and Google Buffett indicator. That'll show the overvaluation from Buffett's side. But Berkshire Hathaway, which is Warren's company, is sitting on a pile of cash, and no one's really talking about this. So what people are sort of suspecting is that Warren also sees that something's coming, and will scoop up deals once the prices are low. So again, the markets are overvalued. The last reason why I think the stock market is due for a correction and other financial markets are the low interest rate environment. Interest rates effectively now are 0%, or effectively the cost of capital or to actually borrow money is very, very low. Why is this important? Well, businesses that aren't doing well will oftentimes borrow money to sort of fund normal operating cycles. So maybe to make payroll, to buy inventory, and so on. They're taking more debt on. And with lower interest rates, you have an environment where companies are taking more and more and more debt on. That's corporate debt. Just to give you some more perspectives, again, this is less related to the stock market, but a larger issue that I've alluded to in previous videos is that we have a significant debt problem globally. Just to give you some perspective. So a lot of data is on the US, so I like to talk about the US a lot. But the United States in the year 2000 had a federal debt of about five and a half trillion. Okay, so 5.5 trillion, 5 trillion, let's call it, in the year 2000. Okay. Last year, the federal debt in the US was about 22.5 trillion. Okay, so obviously there's been a significant increase. From last year to this year, the government has added almost another $5 trillion of federal debt. Okay, so if the federal debt in the US all the way up to the year 2000 was about 5 trillion, and in less than 1 year, the US has almost added that amount of federal debt onto their debt levels. That shows you that we've got a debt problem. The U.S. debt, federal debt right now is almost 27 trillion. So within the last year, they've added almost 5 trillion, or the amount of total federal debt up to the year 2000. So just think about that. How many decades of debt that would cause to add 5 trillion up to the years 2000. And within 1 year, they added that much more debt to the federal debt. So we're about 27 trillion in the U.S. Canada's no better. Feel free to Google the federal debt figures for Canada. But the problem here is that all of these reasons are spooky reasons. It's cheesy, it's Halloween, whatever, take it or leave it, but it's spooky to see these things happening. So again, be aware of this. Get do your financial research. Get that financial education to a point where you understand these things, because these things are extremely important, particularly for those of you that have retirement accounts, pensions, and so on. Just be aware that likely we're going to see some volatility, so just be prepared. Anyway, happy Halloween to all of you, and I hope you guys have a great rest of your day. Again, my Facebook page is The Financial Mechanic. I have a YouTube channel called The Financial Mechanic. Please share this if you found this helpful. Please subscribe, click like on my Facebook page. I would love to hear from you. Again, have a great day, guys, and we'll see you in the next video.